Good morning, everyone, and welcome to a Noble Capital Markets Emerging Growth Virtual Conference. I'm very pleased to introduce Vince Holdings, VNCE is the stock symbol. I initiated coverage on Vince Holdings, and by the way, I'm Michael Kopinski, the Director of Research and the Media and Entertainment Analyst for Noble. I initiated coverage with an outperform rating and a $3 target. And I also indicated illustratively that if you look out to 2026, I look at the stock could more than double from even my current price target. So there's a lot of upside here as the company executes their growth strategy. Here to describe that, we're going to turn it over to Dave Stefko. We also have John Sospansky here to talk a little bit about the company. And so without further ado, I'm going to turn it over to Dave. Go ahead, Dave. Welcome.
Thanks, Mike. Appreciate it. Hi, everybody. Also joining us today is our head of investor relations, Akiko Okuma. Thank you. Okay, so key investment highlights. So let me give you a little background on Vince, from a perspective of, where we are today. 2023 was really a transformative year for the brand and for the company. We did complete the wind down of Rebecca Taylor and Parker businesses, which are brands that we bought. Unfortunately, we bought them in the fourth quarter of 2019. About 4 months before the start of COVID. And so we had to wind those brands down and completed that in early 2023. We also completed the cleanup of inventory, positioning and buys, as we worked with our wholesale partners trying to get through the COVID years. We also, in mid-2023, we sold the intellectual property of the company to a new partnership, ABG Vince, for $76.5 million. That allowed us to strengthen the balance sheet, refinance our debt. We also launched a $30 million over 3-year transformation plan to offset the impact of royalties from the ABG Vince transaction, and also to obviously improve bottom line profitability. And then we went back to a focus on our core product categories again, and really focused on growth and margin improvement, investment in new customer growth, brand awareness, and then the reestablishment of our short-term incentive plan, which hadn't been effective, since the COVID years. A little overview of a timeline of the company. The brand was founded in 2022, mainly started as a women's sweater brand, heavy into cashmere sweaters. Other key dates, in 2012, you can see here we launched our first license for the business with Caleres in the shoe category, the footwear category. In 2018, we launched our own subscription rental service of Vince products under the brand Vince Unfold. In 2019, we opened up our first store internationally in London. And then in 2022, we opened our first retail store in China, and we now have 2 stores in China today as we test the market. A little bit about the Authentic Brands Group transaction that we did. You can see on the left-hand side chart, Vince Holding Corporation sold the intellectual property into this new partnership, ABG Vince. We as a company retain a 25% stake in that business, and ABG has a 75% stake. For that transaction, the company received $76.5 million. And then on the right-hand side, what happens today going forward is we make royalty payments into ABG Vince, along with other licensed partners. For instance, Caleres, the shoe license, footwear license agreement, makes royalty payments into there, and then we get a quarterly cash distribution, back from that partnership. Product categories that we sell, and if you're not familiar to us, we started again as a women's apparel brand. About 5 or 6 years later, we added men's apparel. We are a business today is about a 20% men's line, 80% women's line, and then you can see the product categories that we basically license down below: footwear, scarves, and hats, and a few other items that I'll mention in a little bit. Some key brand attributes. The brand is all about quality. It's what the brand is known for. We're known as a timeless product, and our pieces people feel can be dressed up or down for any occasion. Our seasons are more of a basic everyday wear season. We're sprinkled with some fashion. So Vince's mantra is really known as the everyday wear for the luxury consumer is our sweet spot. This is who our customer is. It's really focused on today the age 30 to 50. But we are a generational brand, what you'll find with many brands as a woman approaches, her late 40s, early 50s, her mom is wearing Vince, she's wearing Vince, and her 20-year-old daughter is wearing Vince. From a positioning perspective, this is a survey we did last year of female consumers, Vince consumers. And you can see the first two from a cashmere perspective, we're their favorite. 61% say we're their favorite cashmere brand, 54% say we're their favorite silk brand, and you see who were the other brands listed. So this is reflective of our positioning within our space. But when you go to leather and see that 19% say Vince is their favorite leather brand, leather is a much more luxury consumer focused fabric, and you can see Vince at 19%. It reflective well of how we are a crossover brand to luxury consumer. We are about a 50-50 wholesale direct-to-consumer business. We've been growing that over the last 10 years. You can see we're 84% of our sales, wholesale sales, are in the U.S. We're the #1 and #2 brand at Nordstrom's and Saks and Bloomingdale's, Neiman Marcus. Nordstrom's, who is our largest wholesale customer, about 20% of our total revenues. Nordstrom's tells us that we're their #1 crossover brand to the luxury consumer within their store. From a retail store perspective, we have a little bit over 60 stores today. You can see the concentration of the stores. Vince is a California themed brand. You can see it in Southern California and the Los Angeles, San Diego area. We have a heavy concentration of stores. You see up in the Northeast, obviously in the New York, market, New York, Connecticut. We have a heavy concentration of stores. And then down in Southern Florida, Miami, Palm Beach, Naples, Boca Raton, we have a concentration of stores. What this slide, shows us and should show you is the opportunity from a store growth perspective that the company has. On the e-commerce side of the business, we did relaunch our platform during COVID, completed that relaunch in September of 2022 with the latest version of Salesforce platform. Really is, as you would in a relaunch, really focusing on the customer experience, and the customer's expectations on what the site should provide them for efficient shopping. We also launched in 2022, early 2023, a new consumer data platform, and which has now been gathering data for the last 18 to 24 months. And we now feel like it's time from an investment perspective that we really look at how do we leverage that platform to grow top line business. And then, as I mentioned, we kicked off a transformation program late last year. The target is $30 million over 3 years, more than half of it coming from the streamlining of manufacturing and production operations. As you see our performance or results, and John will talk a little bit about it, you'll see the material increase in our margins. And then another big part of the transformation that we've done through COVID is we've been heavily promotional, as I said in the beginning, to work through over inventory positions. And so again, in the last 3 quarters, really focused on full price selling, getting back to a much more historical promotional cadence for the brand and driving margins. And then the last portion, of course, coming from efficiencies from a spend perspective. So strategically, where are we at today? These are our growth initiatives that we're focused on. Most important us is to drive the brand and leverage our consumer data platform. Again, we have not invested in top of funnel marketing. We have not invested in brand awareness since 2020, and we are now making investments back in that area. We also are focused on growing our men's business from its current 19 to 20% of our business to 30%. I'm happy to say, as an example of the progress, our men's business will be entering all Nordstrom stores here in the next couple of months. We believe our men's business this year will be more in the 22 to 23% range, and that's a big part of achieving our plan there. International expansion, we're very focused on. It's why we opened in 2022 and 2023. We opened up 2 stores in China. We're looking at that market and understanding the consumer reaction. Vince today historically has been sold in 44 countries. So the brand is well known, but obviously there's more investment in brand awareness that we need to make. And we're using these 2 stores as an opportunity to understand the market better, just as we have done in London over the last 3 years. I'm happy to say we're seeing solid performance in our London store, and we look at other opportunities there also. And then the retail doors, as our map of the U.S. showed you, we're only in 15 or 16 of the top 25 retail trade areas. If you remember that map, you look at something like Chicago, there's only 1 store. You look at Dallas and Houston, there's only 1 or 2 stores. Looking at an expanding city like Nashville, there's no stores. A lot of opportunity for the brand. What we've seen from a test of markets where we've entered new markets over the last 3 or 4 years, good examples have been Denver and Charlotte, where we had heavy e-commerce presence in those markets, and we opened stores there. And not only did those stores perform well, we also saw an expanded growth in the e-commerce business there. So we feel we have a fair amount of opportunity with new store growth. And then finally, how do we leverage that investment we've had with ABG Vince? And I'm happy to say that over the first 12 months of the partnership, while over our 20 years, we had created licenses for shoes and for cold weather products like hats and scarves. In the first 12 months, ABG has completed a license for men's suiting, which will be launched here later this year, for leather belts and small leather goods, and also for handbags, both product lines which will be launched in 2025. And with that, I will turn it over to John.
Thanks, Dave. Kiko, you want to flip the slide? There we go. So Dave talked about our fiscal 23 being a transformational year for the company, with the reset on promotions in our DTC network, as well as a reduction in off-price sales in our wholesale channel, driving overall the intent, better quality of sale for the company. When we closed the year last year, we guided that our Q1 top line would be consistent to the trends around that we saw in Q4, with sales being down high single digits. You see here from a Q1 perspective, we did hit the mark there with sales down 7.6% to prior year, and again driven by the reduced promotions and the reduced off-price footprint. That really translated into profitability. You see the gross profit dollars actually increased despite that sales decline. Gross profit rate improved dramatically, 440 basis points to 50.6%. The reduced promotions and discounting and off-price contributed to that, in addition to improved product costs, despite a headwind of that royalty that Dave mentioned with our new relationship with ABG. Reported operating income was $5.6 million versus a $2.4 million loss last year. On an adjusted basis, that 5.6 was driven by a sale of the Rebecca Taylor shares. Excluding that sale, operating income was a loss of $2 million for the quarter, with operating margin down to minus 3.4% of sales, down 300 basis points. And we had guided that the quarter would be down 400 to 375 basis points. So better than our guide, and that's the intent, is to execute to what we say we're going to execute to. As we pivot into the balance of the year, we look at Q2 and our fiscal year outlook. You'll see that the top line trends for Q2 are improving, low single digit declines to flat. So the trend is moving in the right direction, with operating margins down 750 to 500 basis points. And that's really due to a lot of factors, part of it being that Q2 last year was a very favorable operating margin quarter for us. So we're comping that as a headwind. We also have 1 month of that non-comp royalty in the mix, as well as headwinds related to some organization actions and severance as we streamline the organization and really try to keep leadership in the right place with the right elements of the business. As we look at the fiscal year, we're looking at sales growth of low single digits. So that presumes, obviously, back half of the year growth. As we look at our wholesale order book, where we are today, we're about 85% of that order book filled for the year, and the trends are good. So, we feel really confident in that aspect of it, as well as we're leading into, in our DTC network, the season of fall and holiday, which is really strong for us and for our product categories in sweaters and cashmere and warm cold weather gear. That is really our sweet spot. So we see that as also a positive for us. For the year, operating margins are forecasted to be flat to up 25 basis points. And again, that's all driven by everything we just talked about, including the transformation program, where we expect to more than achieve our goals for this year. Just as an aside, from our balance sheet is strong. We closed the quarter in Q1 with inventory down almost 30%, and our debt position reduced by almost 50% versus the prior year, with a stronger balance sheet, better liquidity position. So with that, I think we'll open it up for questions, Mike.
Great. Thanks, John, and I appreciate the presentation. A lot of good material here. So I just wanted to kick it off and with a couple of questions as we poll for questions. And as a reminder to those that are participating, you feel free to ask a question, hit that chat box and send those, and we'll get to as many of those as I possibly can. And so while we poll for questions, I'm going to go ahead and ask a couple. You talked about their transformation plan, and certainly that's a key driver to what I look for in terms of the adjusted EBITDA growth of the company over the next several years. How is that progressing? And I know that you just reported your Q1 and that you showed some significant improvement there in terms of the cost. And so I was wondering if you could just talk about what areas are you seeing the most significant cost savings, and what's driving in areas where what's driving the efficiencies?
Yeah, Mike, just to expand on that, last summer, we engaged with McKinsey to take a deep dive into our cost structure, and also in our looking at pricing and promotion. So a real 360-degree view of the business. And that's where we identified that $30 million of savings that was attainable, $10 million a year. And as you say, as we closed Q1, we see the results coming through the financials. We're pleased with where we're landing. This year, it's about a 70-30 split in terms of what we expect to get out of the program in terms of cost of goods and margin. 70% being cost of goods and margin, 30% being expenses. And we've got many teams really focused on individual work streams to capture those results. And as we reference, it's really coming through on the P&L. So we're on track, and even feeling really good about it. What we are seeing in our business, specifically in the first half of the year, and as we take ourselves off of that promotional cadence, we're seeing a little bit of sales velocity slowdown. So we see the achievement that we're seeing in transformation really buttressing that kind of dynamic that we're seeing in our DTC network. But as I say, as we approach the back half of the year, which is typically our strongest, we feel good about both sides of the equation.
And as you cut down on price promotions and things like that, I was just wondering if you can kind of give us a little sense of how you're viewing the consumer environment in general and the potential impact of macroeconomic trends and things like that, and how that is, what effect that might be having on your consumer in the face of the fact that you're decreasing the price promotions.
Okay, so we are, as a brand, we're not immune to the macro environments, but being in the space that we're in and being really a everyday wear for the luxury consumer, our consumer is much more resilient and not as impacted by the macroeconomic environment. As I said earlier, we are a classic daily product, and so if you look at our seasons, again, we're sprinkled with fashion. More so focused on being her everyday wear. So we're seeing a shift, back to full price selling, even with the macro environment, and as we decrease our promotionality. In the first quarter, we saw a mid-single digit increase over last year in our full price sales, which is encouraging to us and tells us we're on the right track from that perspective. And so obviously, and we're seeing a shift in our customer data platform also, to a more full price customer because we had attracted that promotional consumer. But we're able to segment also when we're in markdown periods on how do we still service that discount customer at the time, when we do be promotional because everybody else in the space is being promotional, or we do have markdown products that we need to move. So we're really pleased with where we're at this point.
And as you mentioned in your presentation, you indicated that while you've given guidance for the full year, and given the fact that you've already given guidance for the first, we already had the first quarter results and you gave guide for Q2, it suggests that you're going to have a very strong ramp in the second half of this year. And I was just wondering, what gives you confidence in that strong second half revenue performance, especially given that we had such a sluggish start in the first quarter?
Mike, I'll take that. There's a few pieces that are driving that. One is, where we are today in terms of our wholesale business. The performance season to date is really strong in our wholesale business, and part of that is that we couldn't sell in as much as we could given some of the liquidity constraints that we had last year. We have normalized that, and as we go through the markets for this year, certainly for fall holiday and the beginning of spring next year, which delivers in the end of Q4, those markets are almost virtually done. And like I said, 85% of the order book that we've got open for those markets are filled. So, we see that demand filling up nicely according to our expectations. And we see us really performing well. Again, in the back half of the year, our strongest season, selling season, strongest for our product, as well as our DTC performance. Despite the fact that we talked about this sales velocity decline, we see that really fixing itself in the fall season, again, because our product is so strong and our customers keep coming back for those key core items. And this despite the fact that we have 5 less doors in our DTC network. So we're really looking at firing on all cylinders as we turn the page into the second half.
Interesting. And I found it interesting too that you were commenting about your e-commerce sales and how that might be driving the prospect of you opening stores in some of those markets, if I got that correct. And so it seems like your database is kind of leading your growth as well and helping support your growth. I was just wondering, in terms of the e-commerce sales, how is that driving, other factors like maybe how the size of the stores and things like that, in terms of, are the footprint that you might look at in terms of the additional markets that you're opening or that you plan to open. How much of this is database led, data led?
Yeah, well, as I said, we've always used our e-commerce, sales performance, to really help us focus on markets and properties that we are interested in. When we look at malls, and understanding that our consumer is a crossover consumer from luxury, we find ourselves, located well within a mall, closer to the luxury wings of the mall, as opposed to, in the outskirts sides of the mall. From an e-commerce perspective, we're really enthused by the opportunities that are in front of us for us to invest in brand awareness and new customer growth. And again, it's an area that we have not invested in over the last couple of years. We see solid performance at register, in the department stores, and we really feel energized by the opportunity now to invest in our customer database.
And I know we're running out of time, so I'm going to ask some quick questions here. Where do you see the most opportunity for growth? Is it in e-commerce or bricks and mortar stores? I mean, how do you balance that outlook?
We look at the white space. I mean, again, going back to the map, we look at the white space and we see the opportunity, for us to open stores around the U.S. We believe that store growth and the consumer today, I was trying to think through, is the consumer today is more store focused than e-commerce focused. We went through those couple of years, where e-commerce was really their choice of shopping. And then when we look internationally, it's why we've opened up a couple of stores in Asia. So again, and when you look at direct to consumer, we see more opportunity on the brick and mortar side than on the e-commerce side.
And I know we're running out of time, so I'm going to go ahead and close with a little commentary. As I opened up the commentary on this presentation, I indicated that illustratively the stock could have some very strong performance, assuming that you execute on your transformation plan here, and that cash flow growth really significantly improves, especially as you look out to 2026. We put a price target of $3 on the stock on the basis of just kind of moving towards your peer group averages, and assuming those peer group averages numbers kind of look at 2026 and that strong growth and cash flow that you can achieve, we could look at a stock of $8 a share, which is significantly higher than you're at. So the risk reward relationship here looks really appealing. So I encourage you to take a look at our report on channelcheck.com. VNCE is the stock symbol. And with that, thank you, gentlemen, for joining us today. I really appreciate it.
Great. Thank you. Appreciate it. Thanks, everybody.